Good afternoon, everybody. Welcome to the weekly wrap up for May 6th, 2022. Hope everybody had a great week out there. It's been pretty nice here. A little bit of rain and overcast, but not too bad here in Colorado. So hope everyone, most of y'all are down in the Texas and in the South. So hopefully it's not too hot down there yet. I bet the humidity is pretty bad. But anyways, like I said, hope everybody had a great week. Kind of a rough week in the markets. Just a lot of volatility, and even with the Fed doing what they say they're going to do, I think they're kind of past the point of, these are the actions they probably should have taken a year ago, maybe 2 years ago. Not created so much, so many dollars. You create 40% of new money in the system. It's not really shocking that inflation is going to be really bad, and to actually squash that, we're probably going to have to get rates up to right close to 10. I don't know. I mean, we'll see how far inflation continues to rise, but until we see some sort of a retracement in the level of inflation we're seeing, the interest rates are going to have to continue to go up, and then the next thing you'll start to see is a retracement in energy prices, which then will have a trickle out effect through the rest of the economy. So it's gonna be a rough one, guys. Hopefully y'all are prepared for it. If you're not, give me a call. I'd be happy to help you get your shit together. So, all right, well, let's go ahead and take a look and see how today's markets did. The Dow Jones finished down 0.3% at 32,899. S&P 500 was down 0.57, closed at 4123. The NASDAQ was down 1.4, closed at 12,144. Small caps were down almost 1 3/4. The VIX was down actually today, which is a little shocking with the market being down most of the day. The VIX retraced 3.24%, closing or at its right now it's at 30.19. Moving over to the other exchanges here in the Americas, Canada was down 0.3, Brazil down 0.16, Mexico down 1.96. Heading over to Western Europe, Germany down 1.6, France down 1.54. I'm sorry, UK down 1.54, France down 1.73. Euro Stoxx was down 1.82. The Netherlands was down 2.01%, Spain down 1.34, Italy down 1.2. Was that Switzerland? Switzerland was down 1 1/4. One up note here: Portugal was up 0.46. Belgium down 1.89. Austria down 0.98. Sweden down 1.17. Denmark down 3.39. The two Russian exchanges were down. The MOEX was down 0.49. The RTSI was down 2.85. Moving further east, Poland. Well, I guess Poland's further west than Russia, but Poland was down, or basically flat, down 0.04. Hungary was down 0.97. Turkey down 0.31. Israel down 0.27. Saudi Arabia was up 0.66. Japan was up 0.69. Those are some of the bright spots in the larger markets. The Asian markets, Australia was down 2.16, New Zealand down 2.48, Shanghai down 2.16, the SCSE component down 2.14, the China A50 down 2.67, the DJ Shanghai down 2.39, the Hang Seng down 3.81, and the Taiwan weighted down 1.72. So everything that was good about yesterday's market, unfortunately, seemed to kind of recede over into the early trading for today in the Asian markets. So, and it looked bad. I mean, out of all these exchanges, we have 1, 2, 3, 4. 4 of them were up for the day. So what was this other one? Indonesia was up 0.45. So not the greatest day in the stock market, unfortunately. So, but again, if you've been paying attention and playing along, you know that this is quite expected at this point. I personally thought that we probably would have had some sort of a market crash before now, but hey, you keep trying to juice the economy, I guess that's going to happen. So, all right, let's take a look and see how the markets did for the week. Looks like the Dow's almost flat for the week. Finished down 0.21. The S&P 500 looks like it was down 0.24%. NASDAQ like it finished down about 1.3%. The Dow Utilities, looks like they finished up about 0.39. And the Dow Transports finished the week in the green at about 0.33 up. So it wasn't all bad. The utilities and the transports looks like they did, had a flat week. The Dow, just under flat. It looks like the NASDAQ took it the worst. So, but again, to be expected. So I wouldn't be shocked by everything that's going on. So, all right, well, let's go ahead and jump into the economic data that came out this week. Wow, gosh. The initial jobless claims came in this week at 200,000. We were forecasting 182, so a smidge over. A little bit of a jump up from the previous weeks. It's the first time since the end of March where we've been over 200,000 or higher. So, but I wouldn't get my panties in a bunch over that. Continuing jobless claims came in at 1.384 million. The forecast was 1.4. Looking back on the historical, looks like the trend is still continuing in a good direction. So, we're back below 1.4 million. And we've been there a couple times so far this year. So, but again, the trend looks good. I would expect once the economy cools off due to the interest rate increases, we might start to see some climbs in the jobless reports. All right, U.S. ISM Manufacturing Purchases Managers Index came in at a 55.4 number. We were forecasting a 57.6. So again, this has been trending down for the last few months. I believe if it goes below 50, that's a sign of contraction. Let's see here. It doesn't really say. All right. U.S. factory orders month over month came in 2.2% above the mean. The forecast was 1.1. So basically double. And it's, we had a negative month last month. So it's good to see that bounce back. The U.S. Job Openings and Labor Turnover Survey job openings came in at 11.549 million. Forecast was 11 million. So again, you can see, going back to, where things bottomed out a couple of years or two, I guess that was June of 2 years ago. We've had just this steady climb because we were at about 7 million jobs, 7 million jobs for, 18 and 19. And then, that's gone up significantly by about, more than 50% over the last year or so. All right. The interest rate decision came in this week. The Fed decided to raise rates by a 0.5 percentage point. The market seemed to like that for one day. And then the rest of the week has been pretty much terrible. So I think that puts us right around about 1%. And you can see this chart going back to the early 80s where, interest rates didn't really start to recede until about September, October of 84. They were in the 10, 11% range. Wow. Then by, the late, I guess mid 80s, August of 86, they kind of bottomed out at about 5.75, went back up by the late 80s up to just under 10%. By 92, we were back, by September of 92, we were back at 3%. And, it kind of jumped around for the next couple of years. But since the downturn in 2008 and 9, we've been sitting at 0.25% for forever. It wasn't until, 2016 where they started raising rates slightly. And in 2018, interest rates or mid 2019, interest rates had gotten up to about 2.5%. And that's when, if you've been, watching me on a regular basis, there was a lot of talk of the taper tantrum because, the markets got really upset because the Fed was raising rates, which makes investing more expensive when you're borrowing the money to do it. And then the Fed started lowering rates, and then we headed into, the whole Corona BS, and things fell apart. All right. U.S. ADP non-farm employment change was only up 247,000. The forecast was 395. So a bit off of the forecast. So see here, the unemployment rate was, I believe, unchanged at 3.6%. The forecast was 3.5%, so off by 10 basis points there. Again, not the end of the world. All righty, so let's go ahead and jump into today's market recap. S&P 500 deepens losses as stronger jobs report fails to turn tide of selling. It's written by Yassine Ibrahim from Investing. The S&P 500 dropped Friday as a better than expected monthly jobs report fueled investor bets on more aggressive Federal Reserve rate hikes ahead, stoking fears of slow economic growth. Non-farm payrolls increased 428,000 in April, above consensus expectations of 391,000 new jobs, with unemployment rate unchanged at 3.6. Yeah, if you see here, this one was non-farm employment change. So anyways, yeah, there's a bunch of different reports as far as jobs numbers, and they're all slightly different, but I was using the one that that's on my Monday newsletter. Quote, I'm sorry, let me jump back up. Wage growth slowed to 0.3% for the month, but economists continue to forecast wages to resume their uptrend amid a tight labor market. Quote, we still expect the unemployment rate to drop to 3% by the end of the year and wage inflation to accelerate towards 6%, which in turn will put a floor under inflation around 3.5% to 4%, Jeffrey said in a note. I don't know about that, Jeffries. Inflation is expected to trend above the Fed's 2% target for some time, exacerbating investor worries about the impact on the consumer, which makes up about 2/3 of economic growth. Quote, Fed Chairman Jerome Powell was hopeful that he could derail inflation without a, quote, significant, end quote, increase in unemployment. Diane Swonk, chief economist at Grant Thornton, said in a note, quote, hope it's not the same as reality, end quote. Tech stocks, which suffered a rout a day earlier, continued to come under pressure from rising treasury yields as investor bets on more aggressive Fed monetary policy tightening continued to heat up. Google, parent Alphabet, Microsoft, Amazon, and Meta were down more than 1%, while Apple bucked the trend to trade above the flat line. Materials were also a big drag on the broader market, led by Vulcan Materials, Corteva, and Ball Corporation, with the latter down more than 7% following negative commentary on the stock from Wall Street. Quote, we are downgrading Ball Corporation to sector perform rating from outperform given inflationary cost pressures in EMEA, the suspension of its Russian operations, and weakness in Brazil, RBC said as it cut its price target on the stock to $81 from $100. Under Armour, meanwhile, plunged more than 23% after reported a surprise loss and guidance that fell short of estimates as supply chain woes continue to weigh on growth. DraftKings fell more than 8% after paring gains, even as the sports betting company reported quarterly results that beat both the top and bottom lines. Energy stocks sidestepped the broader trend, lower as oil prices climbed as supply fears persist as the European Union tweaked its Russia oil embargo plans to allow Hungary and the Czech Republic and Slovakia more time to implement the ban. The EU is expected to reach a decision on its Russian oil embargo plan this weekend. In other news, Peloton Interactive slipped 6% following a Wall Street Journal report that connected fitness equipment company is looking to sell a 15 to 20% stake to bolster its balance sheet. Excuse me. Yeah, so lot of churn in the markets right now. It is not the best. All right, more good news. Oil settles up of 1.5%, another weekly rise on supply concerns. It's written by Arathi Some Sekar from Reuters in Houston. Oil prices rose almost 1.5% on Friday, settling with a second straight weekly increase as impending European Union sanctions on Russian oil raise the prospect of tighter supply and had traders shrugging off worries about global economic growth. Brent rose $1.49 or 1.3% to settle at $112.39 a barrel. WTI crude climbed $1.51 or 1.4% to settle at $109.77 a barrel. In near terms, the fundamentals for oil are bullish, and it's only fears of an economic slowdown in the future that it is holding us back, said Phil Flynn, an analyst at Price Futures Group. For the week, WTI gained about 5%, while Brent nearly 4% after the EU set out an embargo on Russian oil as part of its toughest yet package of sanctions over the conflict in Ukraine. Hey, EU, how about stay the hell out of it? That's probably the best thing. We're in this situation right now with Russia and NATO and, Ukraine being the teddy bear in the middle that's getting yanked back and forth. I heard someone jokingly say that the U.S. will put up a fight till the last Ukrainian is dead. So, anyone who thinks our government gives a damn about anyone elsewhere or even our own people, I got a rude awakening for you. All right, let's see here. The EU is tweaking its sanction plans, hoping to win over reluctant states and secure the needed unanimous backing from the 27 member countries. 3 EU sources told Reuters the initial proposal called for an end to EU imports of Russian crude and oil products by the end of the year. Yeah, way to really drag that out. Quote, the looming EU embargo on Russian oil has the makings of an acute supply squeeze. In any case, OPEC Plus is in no mood to help out, even as rallying energy prices spur harmful levels of inflation. PVM analyst Stephen Brennick said, ignoring calls from Western nations to hike more output, the OPEC Plus stuck with its plan to raise its June output target by 432,000 barrels per day. However, analysts expect the group's actual production rise to be much smaller due to capacity constraints. Quote, there's a chance of certain members filling that quota as production challenges impact Nigeria and other African members, said Jeff Halley, senior market analyst at senior market analyst Asia Pacific at Owanda. On Thursday, a U.S. Senate panel advanced a bill that could expose OPEC Plus to lawsuits for collusion on boosting oil prices. No way. The oil-producing countries are using this to their benefit. I am just flabbergasted. On the supply side, U.S. oil rig count, an early indicator of future output, rose 5 to 557 oil rigs this week, the highest since April of 2020. I think we were probably in the 600s back in this time. Well, maybe not April, but definitely in February or March. So we're getting there. But again, there's a lot of reasons, the dollar creation, the squeezing of U.S. supply. There's a lot, it's not just one thing that has led to the price at the pump going up. Investors expect higher demand from the United States this autumn as Washington unveils plans to buy 60 million barrels of crude to replenish emergency stockpiles, yet signs of weakening global economy fed demand concerns, limiting oil price gains. On Thursday, the Bank of England warned Britain risks a double whammy of recession and inflation above 10%. It raised its interest rates a quarter of a percentage point to 1%, their highest since 2009. So, yeah, not good. Not good. All righty. One last article here has to do with Fed policymakers and or some ex-Fed policymakers on what their thoughts are. Former Fed policymakers call for sharp U.S. rate hikes, warn of a recession. Written by Ann Safir and Lindsay Dunzimir. All right. 2 ex-Federal Reserve officials now freed from having to set economic policy and be accountable for it are warning the U.S. Central Bank will have to raise interest rates by more than expected, and the outcome could be a recession. No way. Cautions neither voice before leaving their post a few months ago. Yeah, of course they're not going to say anything. That's where they're getting paid from. The remarks this week from the Fed's 2 most recent vice chairs, Richard Clarida, who until January served as one of Jerome Powell's top lieutenants for monetary policy formation, and Randall Quarles, who oversaw banking regulations to the end of last year, ranked among a small course of former U.S. central bankers now offering up critiques where the Fed policy stands and is headed. Well, while you were working there, dumbass, why didn't you say anything then? Now you have no control and no power. And now now you have an opinion. It's like the people who leave politics and then now they're big mouths about whatever they feel strongly about. Clarida now returned to academia, shocking, as an economics professor at Columbia University. Well, I can tell you, anyone taking his class is probably not going to learn a lot about economics because they've done a terrible job the last 20 years at the Fed. Said on Friday that the Fed will need to raise interest rates well into, quote, restrictive territory, end quote, to slow economic growth and curb inflation. Quarles, who has returned to the Utah-based investment firm he co-founded, chimed in earlier this week that a recession was now, quote, likely. The dour views from the ranks of former officials comes just as Powell has ramped up the central bank's battle with inflation by raising interest rates a half a percentage point and all but promising two more such rate hikes by July. The pace of policy tightening is designed to get overnight borrowing costs expeditiously, in quotes, to a neutral range of 2.25 to 2.5%, and in position to rise further if needed. Powell said he saw, quote, a plausible path, end quote, to cooling inflation without creating an economic downturn. Powell, you're an effing moron. You know what's going to happen. You just are too chicken shit to say anything. Clarita, speaking Friday to a conference at Stanford University's Hoover Institution, said the Fed will need to raise interest rates, quote, at least 3.5%, if not higher, to bring inflation back down to its 2% goal. Quote, the Fed has the tools to meet the challenge. Officials understand the stakes and are determined to succeed. Yeah, right. As long as their checks clear, they don't give a damn. Said Clarita, whose role as Fed at the Fed gave him huge influence over policy, but constrained him from departing in public much, if at all, from Powell's views. Quote, but the Fed's instruments are blunt. This mission is complex and difficult trade-offs lie ahead, end quote. Yeah, people who work for the government love to make mountains out of molehills, and, you take a small problem, you make it worse. My favorite quote is, the government will break your leg and then sell you a crutch and then want a thank you the way out the door. So, I mean, they do nothing but screw shit up. And, now we have to deal with it. And most of these jackasses who have high paying salaries are just going to float along, move on to the next government gig, whether or not it's the Treasury or somewhere in government or back to the academia where, those fools do nothing but hide. Anyways. Quarles, who while at the Fed was more overly hawkish than Clarita, was even sharper tongued this week. Quote, we would have been better served to start getting on top of it in September, end quote, he told the Banking with Interest podcast, blaming the delay, at least in part, on President Joe Biden delaying until November the decision to renominate Powell for a second term as Fed chief. Yeah, of course, it's Brandon's fault. Now, with inflation pressures intense, unemployment low, and a demand for outpacing supply, the effect of rapid rate hikes, quote, is likely to be a recession, said Quarles, a Donald Trump appointee. Why does that matter? Who left his post in December when he did not get Biden's nod for a second term. Neither he nor Clarita, also a Trump appointee, again, doesn't matter. Their job is, I didn't do a better or worse job depending upon who the president was when I was serving in the Navy. I had a job to do and I did it. So it just, let's see here. Neither he nor Clarita, also a Trump appointee, called for sharp rate hikes before leaving the Fed. Bill Dudley, who ran the New York Fed until 2018, also says the Fed has been late to raise rates and that recession will result. Pain ahead. Powell, for his part, has acknowledged that engineering a soft landing for the economy will be challenging and that the high borrowing costs that lie ahead will cause, quote, some pain for Americans already struggling with higher prices. Yeah, it's going to be the little people at the bottom who, they already can't afford to fill up their gas tanks. Foods get more expensive, rent's going up. And, the people you claimed that you were helping by creating all this money 2 years ago, most of that money went right back into the pockets of their cronies. And, the little guy is getting screwed. So, quote, but the big pain is not dealing with inflation and allowing it to become entrenched, he said Wednesday. On Friday, Clarita said that as early as last summer, he saw the inflation risks were, quote, skewed decidedly to the upside. If inflation now at 6.6% by the Fed yardstick is a year from now still running at 3%, quote, simple and compelling arithmetic by a widely cited policy guide known as the, quote, Taylor rule means rates will need to rise to 4%, he said. Clarita made the remarks at a conference conveyed by Stanford's John Taylor, the author of that rule. Several other economists speaking at the conference also made the case for a sharper set of rate hikes than the Fed is currently signaling. To current Fed policymakers, Fed Governor Christopher Waller and St. Louis Fed President James Bullard will also speak at Friday's conference. Both have been pushing for faster rate hikes for months. Taylor delivered his own paper arguing the Fed's policy rate, which after this week's rate hike is in the 0.75% to 1% range, should be at least 3% and possibly more than twice that to bring inflation back down to 2% this year. I think I've been saying that. And I'm not even an economist. I'm just some schmo who does a lot of reading. Powell, Powell has said he does not expect inflation to drop that fast, though rising rates should start to bring it down later this year. A, quote, softish landing will, quote, not be easy, he said, but the economy is, quote, very strong and well-positioned to handle tighter monetary policy, end quote. A Friday report showed U.S. job growth increased more than expected in April, and the unemployment rate held steady at 3.6%, provided some fresh evidence for that view. Yeah. Again, people in government are morons, and they will lie to your face just to keep their jobs or to get elected or to get into a position, and then screw you over at the end. So anyways, hope everyone has a fantastic weekend. That's all I had for today. So not to bring everyone down, but we're going to go through a world of crap. For all those folks who've seen Shawshank Redemption, we are getting ready to crawl through that river of shit like Andy Dufresne. And hopefully you got some foul weather gear to put on, because I don't think you want that garbage on your skin. So anyways, so like I said, hope everyone has a great weekend. I'll be back Monday with the weekly economic update. If anyone needs anything from me, feel free to go to dsafinancialgroup.com. All my contact information is there. If you want to give me a call, drop me an email, schedule a meeting, please do. I'll always make time for someone who wants help with their finances or their retirement plan or whatever it might be. But that's on you. You have to get off your ass and actually give me a call. So, all right. Like I said, hope everybody has a great weekend, and I will see you later. Adios.